Good day, my name is Dean Crocker. I'm a Senior Equity Analyst with the PSG Wealth research team. And today I'll be taking you through our latest EIA report completed on the South African banking sector. So just by way of introduction and a bit of an executive summary, there's a few key points I'd like to leave with you following the presentation. I think what's worth noting is just the narrative of the background to the report. So what we've seen is that a lot of the international as well as the local banks have been slowly releasing their COVID-related provisioning, largely attributable to their loan book portfolios. And as such, we wanted to kind of understand whether that was justified. Given the backdrop of the South African economic environment, which has mostly been quite negative of late, we've seen extremely high unemployment rates, as well as a high proportion of debt relative to gross income of the public consumer. So just in terms of the few key takeaways from this report, so the sector does seem to offer value right now relative to kind of where it was pre-COVID levels. There is a key table that I'd like to show you relative to the valuation multiples. What we have noticed, however, is that there is a negatively skewed structural shift in terms of the gross loans and advances. This does imply that the portfolios are not as well performing as one would expect or like, and there might be a bit of a disparity between what we've seen in terms of gross loan portfolios relative to the expected credit loss ratios. There is a key table to reflect that, which is effectively the gross loans and ECL deltas. And then there really is just a macroeconomic backdrop, and we have included a bit of it in the EIA. I think the biggest areas there of concern is we have the significant high unemployment rates, 44.4%, with 2 out of every 3 people between the ages of 15 and 24 are currently unemployed. Now this is effectively your up-and-coming working population, your next generation, which is quite concerning given that banks thrive off higher income and a working populace. Then finally, we believe that Standard Bank, out of all the local banks, the 4 local banks, seems to offer the greatest value, not just in terms of the greatest upside, but just in terms of the balance sheet strength. We also believe that they are relatively more secure than the other banks. There is a skewness towards fee income, with potential earnings accretion following the proposed Liberty transaction. Right, so as I mentioned, just looking at the valuation metrics, Nedbank does seem to offer the greatest or the lowest valuations relative to a higher dividend, relative to the sector. You can see that in a few of the tables in our report that most of the banks, if not all, are trading below their 5-year average in terms of price to book value, as well as below that of their pre-COVID levels. With regards to the event, so effectively this was really just a review of the banks, their asset base composition, the performance thereof, and also how the banks have performed of late. So what we've noticed, and there's a nice table in EIA, just reflecting that the total assets are up across all of the banks, so the entire sector has seen an increase in total assets. The net loans and advances have seen an increase across all except FirstRand, which has reported no growth, and that is a bit of a concern to us. It is covered in the EIA, but effectively, in terms of a loan book, if you aren't putting new loans on top of the older loans, your proportion of non-performing loans starts to come through and it increases over time, which would imply that the risk of that portfolio increases, and thus there is a potential provision release that FirstRand has. We do not expect that to materialize given that. Financial assets, we have seen a structural shift there in terms of FirstRand moving most of their asset allocation to financial assets, so that would improve the riskiness, would de-risk their balance sheet to an extent. Household debt, and this is really now back to the macroeconomic conditions, sitting at 66.7%. It has improved slightly. It is still significant, with unemployment rates sitting at 44.4%. And as I mentioned, 2 out of every 3 effectively teenagers are still unemployed, which is very concerning. In terms of the household debt, I think the biggest component there that worries us is, we are sitting in a very low interest rate environment right now. Banks do generally benefit from a slowly increasing interest rate environment, but there is an inflection point at which the interest rates increase too much and the cost of debt exceeds that of the increase in their disposable income, which results in a significant increase in your credit losses. So under the new IFRS 9 methodology, if it sits in a stage 3 loan, you don't get to recognize the full interest revenue because you have to reduce the gross carrying value by the provisioning value. So it does concern us that, yes, we might see a benefit to the banks in a slightly increasing environment, but there's an inflection point. That point we're not too sure of as yet, but I suspect that, basis points 200 to 300 is probably that sweet spot. In terms of impact, so you can see that, the banks have performed relatively well on a year-to-date basis. Following COVID, the entire market took a knock. Banks have recovered quite strongly, but not yet back to pre-COVID levels. I would suspect that they potentially wouldn't jump straight back to pre-COVID levels, given that there's still that overhang of the COVID potential provisioning, as well as the riskiness of portfolio. Nedbank was the top performer, and then Standard Bank lagged the rest. So just in terms of the gross loans portfolio, so I mentioned that negatively structural shift. You can see on the table on the left the gross loans delta. Now this is effectively just comparing the pre-COVID loan portfolios on the 3 stages relative to the post-COVID, or where we are right now. What you can see is that there has been a structural shift in terms of the allocation to stage 1 loans, which means that your real performing loans, the good loans, has diminished. Nedbank has seen the largest fall, more than 5% in terms of their performing loans, while stages 2 and 3 have to increase by a proportionate amount relative to stage 1. And what we've seen is that loans are moving to stage 2, and generally if they don't continue to perform well, they'll move straight to stage 3. But that structural shift just implies that the loan portfolio has implicitly become a bit more risky because you have a greater proportion of non-performing loans. If you look at the graph on the right, the ECL delta, this is effectively just comparing the ECL percentages, or your provisioning percentages, pre and post-COVID. Now what you can see is that anything above 0% is conservative, which implies they are still at a rate above what they were pre-COVID, which just implies that they're taking a higher provisioning right now, so it's more conservative in nature. While anything below 0% is more aggressive, so they assume right now that the stage is actually performing better than pre-COVID implicitly. So looking at that data, you can see that Standard Bank effectively has taken a conservative approach to the stage 1 and 2 loans, but stage 3, they assume they're actually performing better now than they were pre-COVID, which we find relatively hard to believe. Same for Nedbank. You can see that there's a greater proportion of stage 3 loans. Now, we've just spoken about the macroeconomic conditions of South Africa, not exactly very favorable right now. So I find it a bit hard to believe that those portfolios in the stage 3 loans are performing better now than they were pre-COVID. Nonetheless, that's how it looks. FirstRand, Absa, you can see that they're still quite more provisioning heavy in terms of conservative, and they'll offer the greatest provisioning release there in that sense. FirstRand, we do however believe that given that they haven't been growing their top line in terms of the provision, in terms of the gross loans portfolio, they will have a very difficult time releasing provisions because the upswelling of the non-performing loans will continue to come through. With regards to the assessments, so the sector as a whole does seem to offer value. They are trading at a 1.4 times relative to 1.89 times on a 5-year average. There is still further potential provision releases. Not significantly material like it was previously. It seems like that COVID provisioning amount has been released to a large extent. FirstRand has the greatest potential release still. But as I just mentioned, we don't see it to be really likely to materialize anytime soon unless they start to sort out their loan portfolio. And then the macroeconomic conditions do not seem very favorable right now for longer term growth. Relative to the intrinsic value, you can see that we've completed a bull, bear, and bear scenario, weighted more towards the bear scenario right now, just given that we are a bit more pessimistic about the economic conditions right now. And on the back of that, we've calculated the intrinsic value for the 4 companies. In the EI, I have completed a nice little just key highlights on various banks and where they stand. But based on our analysis, we do feel that Standard Bank is probably the preferred choice right now. Albeit that the whole sector does offer value, we believe that Standard Bank, through the latest Liberty transaction, might have some earnings accretion. There is a large weighting of their total asset base towards Liberty, which is more fee income driven. So long as the COVID pandemic doesn't continue to hamper the life insurers as it has in the past, we believe that Standard Bank could potentially show the greatest upside in that section, as well as the lowest risk component. So if you'd like to place a trade, please speak to either your financial advisor or the trading desk is more than happy to assist. Please take note of the disclaimer and have a great day further. Thank you.